How is it looking on the economic calendar this week? Let's find out with Bob Mason of FX Empire. This is the week ahead. Hello, Bob, and thank you once again for joining us today as we look at the week ahead. Let's start with the fourth quarter GDP figures that are due out on Thursday. How do you see the markets reacting to this?
On the economic calendar, and GDP numbers are in focus with US numbers out on Thursday. We saw third quarter growth at 2.1%, and that was good enough for the markets, and that led to the recovery of US Treasury yields that had inverted and led to a rising risk of a US recession. We saw China's growth for 2019 come in at a 30-year low, so the market's going to be pretty unforgiving if there's anything lower than the 2.1% we saw in the third quarter. As far as the Fed's concerned, economic growth is expected to continue. The IMF, however, revised growth for this year down to 2% and to 1.7% for next year. So anything softer than 2.1%, expect the markets to panic. We can see Treasury yields narrow, and the rising risk of a further rate cut even by the Fed should economic pressures ease back, and that would support Trump's desire for zero rates, though that remains highly unlikely. So yeah, plenty of sensitivity to the numbers on Thursday. Anything above 2.1%, expect the markets to really get a boost and the dollar to find further support. Economic growth indicators out of the US have been fairly positive, especially when we're looking at consumer confidence and retail sales. So all in all, we're expecting decent numbers, but if there's anything softer than 2.1%, expect the dollar to sink.
Let's switch our focus now to Asia. How are the big four players in the Asian market doing, and how do you see next week being for them?
It's a busy week in Asia next week on the economic calendar. The markets will have to wait till Friday, however, for numbers out of China, with the Chinese markets closed for Chinese New Year. Private sector PMI numbers are due out on Friday, and they're going to need to show some uptick in activity to support the markets and market risk. We saw growth slow to a 30-year low in 2019, so we're going to need to see a turnaround at the turn of the year. And with the phase one trade agreement in place, the markets are going to need to see some moves. We're not expecting any filtering through from the phase one agreement just yet, but expect some market reaction to any dire numbers. Moving across to Australia, after better than expected employment figures last week, we're still expecting the RBA to have to make a move to support the economy, with bushfire impact having affected consumer confidence. Obviously, we don't have any retail sales figures to digest next week, but inflation numbers and business confidence numbers are due out, both of which will further influence the RBA in February. Any softer inflationary pressures and fall in business confidence expect the Aussie dollar to come under further pressure. For the Kiwi dollar, we got trade data due out. We're going to need to see the trade deficit narrow further to support the Kiwi dollar. Expectations are for the RBNZ to stand pat, and these numbers are going to need to support that. Exports are going to need to provide support, else we could see the Kiwi dollar backtrack as well. For the Japanese yen, we've got to look ahead to Friday. We've got retail sales and industrial production figures that are the main areas of focus. BOJ was a little bit more optimistic on inflation and on growth, so production figures will need to provide support, and we've seen some dire household spending numbers, so retail sales need to impress as well. Inflation numbers are also due out, but we expect less influence from those numbers on the day.
With the impeachment trial of President Trump in full swing and Brexit on the horizon, do you see any of these geopolitical risks affecting the market next week?
On the geopolitical risk front, yes, we've got impeachment trial that's ongoing. We're not expecting any material impact on the markets, however. That is, of course, unless Republicans start jumping ship. Really, the area of focus will be whether Trump looks to divert attention from the trial. That could include the likes of tariffs on the EU. There's been plenty of chatter on that. And also we've got Iran and the Middle East simmering in the background. So should things start getting a bit hot under the collar for the US president, that we can expect some magic tricks and some distractions. And I'd expect the EU probably be the main area of focus, which could hurt the European markets and the euro. No one really wants a Eurozone, EU-US trade war, following off the back of the US-China one. On the Brexit front, it's Britain's last day as a member of the EU on Friday. We saw the withdrawal bill get its final seal of approval by the Queen last week. So it's all green and go for Britain to move into its transition period we're not really expecting any effect on the markets. We've seen that expectation now since Boris Johnson's victory in December. So it should be status quo for the pound. That is, unless, of course, EU member states start causing a bit of grief by talking up, resistance against forming trade agreements with Britain. On that front, how Britain progresses with other trading partners will be key near term. However, rather than that on the EU, we're not expecting things to be wrapped up pretty quickly with the EU. So with the likes of Australia, Africa and the US, there'll be plenty of attention there, and of course Latin America and so on. So plenty to consider in the week ahead, but Trump and the impeachment and Brexit directly should have a muted impact on the markets.
And finally, with some big names due to release figures next week, namely Netflix and Microsoft, for example, how do you see this affecting the market, if at all?
On the corporate earnings front, we've got some marquee names due to release this week. We've got Netflix and Microsoft, a couple of big names. On the Netflix front, we saw negative sentiment towards forecasts for guidance last week weigh on the stock. We're not expecting Netflix to have a material impact on the broader market, however, though we will expect the likes of Disney, Amazon, and Apple and YouTube to respond to any weaker figures. The negative forecast could pave the way or set the markets up for an expectation of weaker numbers. So we've already prepped for that. Microsoft will have a bigger influence, however. Analysts are particularly bullish about earnings. Earnings per share forecast at 132. That's up from 111 from last year. Anything softer than that, and expect the markets to take a hit. The good news is that we've seen some upward revisions to forecasts, which suggests that earnings should be positive. All in all, markets have been pretty forgiving on the earnings front. So barring any particularly dire numbers, we're not expecting any market corrections. Though do expect the effects of Trump's tax cuts to begin to have a diluted impact on earnings going forward.
Okay, Bob, thank you once again for joining us. That was the week ahead, and we will see you again next week.